behalf of the Real Estate Board of Greater Vancouver, I'd like to thank you for joining us today for our virtual event, Succession and Retirement, What Realtors Need to Know. You're going to learn a lot today, but don't worry, you don't need to memorize anything. You'll be sent a recording of this presentation in the next couple of days. Now on to our presentation. I'd like to introduce our speaker, Bijan. Bijan is a real estate lawyer and the founder of Bijan Law. He works with realtors every day, helping them structure deals, conduct due diligence with closings. He has extensive expertise working with both residential and commercial real estate contracts. Welcome, Bijan.
Good morning, everyone. Can you hear me?
Yep.
Okay. Thanks very much, Denisha, for that introduction. My name is Bijan Ahmadian, and as Denisha said, I am primarily a real estate and business lawyer. I also help realtors structure deals and do tax planning, as well as retirement and succession planning. It is a pleasure to be presenting to you today, and I appreciate the Real Estate Board of Greater Vancouver's invitation. So let me walk you through the agenda for today, things we are going to cover and things that we are not going to cover. First of all, I'd like to tell you that this presentation is not a legal advice. It's for information purpose only. Every person's situation when it comes to retirement and succession planning is different and requires a professional to review those facts and circumstances with the individual directly in order to give you advice that works for you. Things we will cover today are basically three topics. I'm going to walk you through personal real estate corporations, the so-called PRECs. That's the number one thing that I get questions about. And I'd like to walk you through some practical stuff about whether or not to incorporate. And if you incorporate, what are some of the considerations you should make when you're thinking about retirement? What's the pros of a PREC? What's the cons? And how should you take advantage of it if you choose to incorporate? The second topic will be about wills and family trusts. So you have your PREC on one side, but now you need a will. And there are more than one ways you can structure your will, and you can take advantage of certain tools like family trusts that could potentially be advantageous to you when it comes to delaying or minimizing taxes. So I'll tell you what those structures are. And finally, I put together a very small checklist of best practices just so that you have something practical to walk away with in order to decide what your next step will be after this presentation. What we will not cover from this is an actual retirement plan that's catered toward any one of you. And I'll say this over and over throughout this presentation to emphasize how important it is that you seek advice from a professional that's catered to your particular circumstances. This presentation will tell you about some of the main issues, some of your options, so that when you go and talk to such professional, you will be able to ask some of the right questions. Okay, let's start with the Personal Real Estate Corporation. The Real Estate Services Act, which is the act that governs the practice of realtors, sets out that you can incorporate your practice. The regulations to that act say that there are certain requirements in order for a PREC to be incorporated. Now, I've covered just one set of requirements that relate to the topics we are going to talk about. There are other requirements that I haven't covered here, so make sure that you do seek advice from a lawyer if you're going to incorporate a PREC. For the purpose of our discussion, you have to make sure that the PREC follows these set of guidelines with respect to control and ownership. These requirements are set out in the regulations. I've basically just copied and pasted them, tightening up the language a little bit. So when you incorporate this company, you as a realtor must be the only director and officer of that company. Officer is usually a president. You must hold all the voting shares of that company. You can have non-voting shares that can only be held by yourself, by your spouse, or by your children. or those shares can be held by a holding company whose shareholders are yourself, your spouse, or your children. And finally, it can be held by a trust with those three people as the beneficiaries. If this doesn't make sense right now or sounds confusing, just bear with me. I have a graphical display of both structure 4 and 5, and I will show you what that looks like. I'll give you a bit more details about why we would be doing any of these things. But to just, if you're going to take away one thing from this slide, is that having a spouse and having children could potentially be used as a tax planning tool. If you are single, you don't have as many tax planning tools. I like to always think of tax planning as you having a board of chess. And the larger the number of pieces that you have on the board, the bigger the kind of plans that you can make. So if you've got a family of your spouse and a number of children, there are things you can do that you wouldn't be able to do if it was just you and yourself. Okay, going forward, like I said, this is my slide. This is where we're gonna just basically relax and spend a fair amount of time so that I can explain to you what a proper PREC structure looks like. And this is the first structure I'm going to show you. Later on, I'm going to show you a second structure that I think is more powerful than this one and takes advantage of the idea of a family trust. But I want to explain the family trust concept first before I show you the second slide. So let's go through this slide that talks primarily about a PREC. On the bottom left side, you will see the PREC as a rectangle. That's how we represent the corporation. Underneath that, it says the real estate services business. So basically, this is a corporation that runs that business. This is, for those of you who have one, you probably know that company has a business number, you get a GST number, you enter into a contract with your brokerage using the PREC, and you include the PREC on all of your advertising material. These are the pieces you've seen other realtors do. So that's the piece on the lower left side. Now, when you create a PREC, you're creating a company, you're giving birth to a legal entity, and that company needs to have two other types of pieces in order to operate. One piece is a board of directors, the other piece is a number of shareholders, okay? And like I showed you in the previous slide, the only person that can be on the board of directors is you and you. There cannot be any other realtors, just one realtor who's running the PREC. The PREC is named after one person. I have not shown the directors on this slide because I'm assuming that you will be personally the director of all of these companies. Now, I will add that the only place that you are required to be a director of is the PREC. In some of the other companies I will cover shortly, you can have somebody else be a director of those companies. What this slide shows are who the shareholders will be. So that's the second entity that I said a corporation needs. So directors are you. Now let's talk about the shareholders. So shareholders of a company can be an individual or it can be another company. And so the way I've drawn this, you see in the middle of the screen, there's another rectangle. It's a corporation and it's called main holdco. That stands for your main holding company. A holding company is just like any other company, and its function is to not do any operation, so it doesn't have a GST number typically. Its function is to hold assets. That's all it does. It's just basically a legal entity for the purpose of holding different types of assets. So that asset could be a real property, or it can be shares of other corporations. So I have a main holdco, and as you see, the main holdco owns the shares of the PREC, and it also owns the shares of 3 other holdcos, each of which own a different asset. So let's just say that like many of my clients that do this, you invest into real estate. What we recommend that you do in order to separate the liabilities that are associated with each property is to buy each of those properties under a different corporation. So asset one would be, let's just say an apartment that you've purchased, and you incorporate a company. The company goes on the title, owns asset one, and that company's shares are owned by the main holdco. Okay, then asset two could be, let's just say you decided to invest into a friend's business, a restaurant, and you own shares of the restaurant. The shares of the restaurant in this diagram would be asset two. They would be owned by asset two holdco, which is a corporation, and then asset two holdcos are owned by the main holdco. Okay, now the shareholders of the holdco, in accordance with the regulations, have to be only the realtor, the realtor's spouse, and the realtor's children. Now, why would you give shares to these folks? When you give shares to somebody, it also allows them to pay that person dividends. So that I'll cover that as one of the ways for you to take money out of the company. Your company makes, let's just say, $200,000, and you want to take these $200,000 out of the company and use it to pay your expenses. If you can take some of it under your name and some of it under your spouse's name, you can potentially split your income. However, there's a big however here. There are certain rules you have to comply with in order to be able to split income that way. And in case of your spouse, he or she has to be involved with the business. The CRA assumes that if your spouse is working on average 20 hours a week in your business, that they fall within that qualification. They're involved with the business, and they can accept a dividend at a lower tax rate. And so this way, you can split your income between more than one person, and you can end up paying a lower tax as long as that spouse or that child is working in your business. I'll show you in a later slide what the requirement for the child is. The child has to have turned 17 in the year that they are receiving dividends. Now, if they don't meet those requirements of being involved with the business, then the dividend that you pay them is taxed at the highest rate, which is over 50%. So that wouldn't make any sense in terms of tax planning. And so it's important to make sure that if you are putting your spouse or your children there, that they will eventually qualify to receive dividends at a lower tax rate. The other thing that you should keep in mind, this was mentioned in the previous slide, but it was in a bracket, and I would like to raise it now. When you issue shares to your spouse and your children, you must make sure that those shares are not entitled to vote. The realtor must be the only one that's entitled to vote, because that's what the regulations say. The realtor is the only controlling person. So the way that we incorporate a PREC is that we create different classes of shares. Usually we say a class A is a voting share. The realtor is the only person that owns those shares. Then we create a class B. We call it a non-voting participating shares, means that it participates in profits and dividends. And we create a number of non-voting participating shares. We give one class to realtor of non-voting participating shares, one to the spouse and one to each of the children. So in the end, the realtor gets the class A voting shares that are non-participating. Realtor gets class B non-voting participating shares. Spouse gets class C non-voting participating shares, and the child gets class D non-voting participating shares. What this allows you to do is it allows you to then give a spouse a different amount than you give to the realtor, than you give to the child, because each of them have different classes of shares. If everybody was in the same class of shares, then you'd have to pay everyone an equal amount, which would limit, again, your tax planning. Remember that chess piece. We want to have as many pieces as we can, so that we can just, you can then think about it and say, okay, well, maybe I will pay myself a dividend in year 2021, but my spouse is going on a maternity leave, but she's going to be involved in the 20-hour a week, and maybe I will pay her a dividend in the year 2021 because she will be on a smaller tax bracket in that year. This kind of plays you can do when you have a structure that gives you that flexibility, like the one that I have shown you. So when you're going to talk to a professional, this is the piece of paper that you should definitely take with you. Have them run you through different ways you can accomplish this, and make sure that it applies to your particular circumstances. Okay, so let's go forward. I want to tell you what are the tax advantages. And specifically, I want to tell you what's the difference whether you incorporate or do not incorporate. So I've called the left side no prec. That means there's no incorporation. You personally, as an individual realtor, enter into a contract with your brokerage, and you earn the income personally. The checks are issued to you. The right side is when you do incorporate and you have a corporation. Your corporation enters into a contract with your brokerage, and it's your corporation that is receiving the income, and the bank account is under your corporation's name. So if you're on the left side, that's simple. Everybody has been there. The realtor receives the income personally, and the realtor pays income tax based on marginal tax rates. I'm going to go to the second slide, and we'll come back to this slide. But I want to tell you what these marginal tax rates are. So here's an example, and this is truly just an example. The way that personal taxes work in Canada is that there are different tax brackets, and you will pay different taxes depending on which province you are in. The federal government charges you a certain tax rate, and the tax brackets for the federal government are different than they are for the provincial government. And each provincial government will have their own tax brackets and their own tax rates. That's one of the reasons why during an election, you hear politicians talk about what they're going to do with the tax rates. This is the table that they are talking about. Now, what I have done is I have combined the provincial and federal tax rates for British Columbia for the year 2021, and I've included some of the brackets. There are actually a total of about 11 or 12 brackets, and I didn't want to make it too big. I know all of you, or some of you, are watching this probably on your mobile screen, and I wanted you to be able to just see as an example. You can go Google search 2021 marginal tax rate British Columbia, and you'll be able to find a full table to see what those tax rates are. But as you see, in the first 42,000, you pay about 20%. If you fall somewhere, and then for the next amount of income, for the next 42,000 to 49,000, you pay 22.7%. You'll see a middle bracket there, and then you will see that if you make anything over $222,000, for the extra amount, you are paying 53.50%, which is more than half. That's what we call the top personal marginal tax rate. I mentioned that top rate in another slide, and I'm going to go back to it now to tell you. You remember how I told you that if your spouse or your child does not qualify as being involved in the business, that the dividends you pay them will be taxed at the top marginal tax rate? I was talking about 53.50%. Okay, so basically, for a certain amount, you pay this tax rate. For anything above that, you pay another tax rate. Anything above that, you pay another tax rate. That's what we call the marginal tax rate. So now let's go back to that slide where we were comparing precs with no precs. So in the prec, you pay the income tax based on those marginal tax rates. In the prec example, you have a corporation. This is an entity that's a taxpayer on its own. This entity is earning money. The commissions are coming to this entity. And this entity first has to pay its own taxes. Keep in mind that this entity will have a number of expenses. You may lease an office, you may hire an assistant, you will definitely pay for advertising. All of those expenses are going to be deducted from the revenue, and then you're going to arrive at what's called the taxable income. So once you have your taxable income, you will pay corporate tax. Now, the reason why people incorporate their practice is because we have something called small business deduction tax rate. I don't want to go into what that definition is because I find in my experience it really confuses people. But I will just stop at saying a prec qualifies as a for the small business deduction tax rate. So that's why instead of using the word SBD rate, which you may have seen in other places, I have used the term prec rate because a prec qualifies for that. So I just want to keep this a little simpler, not provide information that you don't need in order to understand the purpose and the material I'm trying to get across. So prec rate is 11% for the first 500,000 of your taxable income. Okay, it says 500,000 of income, but I mean taxable income. So you have your revenue, you have your expenses, you arrive at the taxable income. For the first $500,000, you pay 11%. So that means for 100 grand of income, you would pay $11,000 in taxes. Now, this is different if you were not a prec. If you were a different kind of a corporation, you would be paying about, depending on the province, about 27% on your income. A prec is a different animal, and it qualifies for that smaller tax rate and only on its first $500,000. Once you go above 500,000 of taxable income, then you pay the full amount of approximately 27%. Okay, so the corporation pays that tax first. After that, the realtor withdraws money from what's left from the balance. So let's just say the taxable income of the corporation was 100 grand. $11,000 are paid in taxes. $89,000 is left that then the realtor can withdraw from. That's the second bullet. The realtor now withdraws money as dividends. Now, the realtor could also do something different. The realtor could withdraw money as a salary. We will spend quite a bit of time talking about the differences between these two. And if the realtor is withdrawing money as a salary, then they are withdrawing it before paying the corporate taxes, because salaries are part of that expense that I told you. Revenue, expense, then taxable income. So if you're paying yourself salary, the salary becomes part of your expenses and your taxable income decreases. One of the biggest questions, the so-called million-dollar question, is which one is best for you? Should you withdraw salary or should you withdraw dividends? Now, if you withdraw dividends, as the third bullet says, let's just say that in that example I just gave you, 100 grand of taxable income, you pay $11,000 of corporate taxes, $89,000 is left. Let's just say you only need $49,000 of that in order to live. You would need more in Vancouver, but let's just say you take 49,000 of the 89,000 out. That means that $40,000 is left in the prec. Now, on the $49,000 that you take out of the prec, you now pay a personal tax based on the marginal tax rate that I showed you. But because you're leaving some money behind in the PREC, $40,000 in this example, then you don't pay taxes on those until you decide to withdraw them from PREC. That's why this slide says tax deferral. When you do tax planning or retirement planning, there are two things you want to see happen with your taxes. You want to minimize them as much as you can, or you want to defer them as long as you can. So this is a tax deferral strategy. In summary, your corporation, after paying taxes, will have a bunch of money you can take out as dividend. If you don't need all of it, you only take out the amount that you need for your personal life. You pay taxes only on the amount that you take, and the rest of it will remain in the corporation. You only have paid 11% of taxes, and you won't pay the additional taxes until you decide to take them out, which means in the meantime, you can invest them and you can grow them. Okay, so I went over this slide and I talked to you about how a PREC is supposed to be structured. But as you'll see at the top of the slide, it talks about asset protection. So that's another piece I wanted to tell you. What's the advantage of structuring your assets this way? So your PREC will be operating, and if somebody wants to come after you and sue you because of some claim they have against you, they say you've caused them damages, they will sue you personally, most likely, and they will sue your PREC. So if your PREC has assets, then those assets will be exposed. And that's why most people have a holding company that holds the shares of the assets. And if you can move things from your PREC to your holdco on a tax-free basis, your accountant should be advising you on that, making sure the proper elections are filed, the proper forms are filed, and the proper resolutions are drafted. But if all of those are properly done, you can move assets from your PREC to your holdco on a tax-free basis, and then use your holdco to acquire different assets. So what you should never do is put all of your investment under your PREC, because then you're exposing yourself. And all of those assets potentially to be collected by somebody who sues you, especially if you end up finding yourself in a position where your insurance is not covering whatever it is that you're being sued for, or your PREC is being sued for. Now, the asset protections, there's always some caveats to that. We have a law in BC called the Fraudulent Conveyance Act, and you have to be really careful about that. The Fraudulent Conveyance Act says that if you do a transaction where the sole purpose of it is to take assets away from creditors, then that transaction is void. Okay, so if you've got somebody suing you, and then all of a sudden you go move your assets from PREC to holdco, most likely that transaction is going to be void. But if at this stage, if you do that at a stage where nobody's suing you, there's no creditors that are coming after you, there's no insolvency issues, then you might be able to save that asset from potentially a creditor's claim down in the future. You should get advice on those transfers specifically from a lawyer, so that they can evaluate your circumstances and advise you what the consequences might be. Don't just move them because you may be exposing yourself to more liability. So that's what an asset protection use of a PREC can be. We've talked about the tax referral as another advantage. The next advantage I have is something called LCGE. LCGE stands for Lifetime Capital Gain Exemption. And before I go into the details, let me tell you that this doesn't apply to realtors a lot in today's market. I don't see a lot of realtors being able to use this. It's typically doctors and accountants and lawyers that use this, but I have included it because, in my opinion, there are ways that a realtor can plan in order to take advantage of this potentially in the future. So let me tell you what this is about and what that planning could look like. What is lifetime capital gain exemption? It's a capital gain exemption on the net gains that are realized on the dispositions of the shares of a qualifying small business, which PREC is one of them. What that means is that, you know how in this previous slide, the PREC's share were owned by a holdco, and the realtor owns the shares that are voting and everybody else has non-voting. Let's just say you get to a point in your career where somebody says, look, I would like to buy your business. I would like to buy your PREC. And you say, okay, sure, I will sell you the shares of my PREC, and the buyer would have to then go and rename it to their own name and make sure that, you know, the voting shares are held by them, make sure that they comply with all the regulations. But that's the easy part. The seller who sells their shares can take $883,000 of that sale price home tax-free. So imagine somebody coming and saying, look, okay, your business is worth $1 million. I'll buy your shares of your PREC for $1 million, and you've never been granted the exemption, because this is a lifetime exemption. Anybody can get it only up to this amount and once. It's cumulative. So if you have sold shares of a company for $400,000, then you only have $483,000 worth of exemptions left for the rest of your life. But that's a big exemption. If somebody's buying your practice for $1 million because they think that they can walk away with your book of business and make piles of money, then you can get $883,000 of that tax-free. And that's amazing. The reason why it doesn't happen with realtors is because if you've got John Smith, a personal real estate corporation, people know John Smith. People have a relationship with John Smith. People trust John Smith. And so it's not likely for John Smith to sell their practice to Brad Cooper and for people to have the same trust and comfort with Brad Cooper. But what John Smith could potentially do, and I think this is the opportunity for some of the mid-level realtors, is a lot of you will bring someone under your wings. This person could be the potential Brad Cooper that's buying the shares of your business. And if this person works shoulder to shoulder with you while you make your way to retirement and meets your clients, builds confidence and trust with your clients, and then your clients are willing to transition to working with him, then you could potentially sell the shares of your PREC to your underwing, and your underwing doesn't have to necessarily have all the cash himself. He can go, you know, get a loan from a bank, and the proceeds of the sale of those shares would come to you tax-free. That would be beautiful. If you can plan for it, that would be a game changer. I've said it's uncommon for realtors because people don't usually plan that way, but it's more common for brokerages because brokerages have a brand and it's easier for them to sell that brand to a new owner, and they can also take advantage of this lifetime capital gain exemptions. And again, I think realtors can as well. The last bullet talks about multiplying that. Okay, so imagine that you're a brokerage and somebody comes and says, I want to buy it for $5 million. So you say, okay, well, I get $800,000 for free. How can I get more of these individuals to get more of these $800,000 so I could get maybe $5 million out of this for free? And I will show you that in a later slide where I talk about family trust. Family trust is something you may have heard about. You may have seen it in movies. And it is a tax planning tool that's lost most of its luster. The tools are not necessarily helpful now than when they used to be about 10 years ago. But one of the pieces that's still left that you can use is multiplying the lifetime capital gain exemption. I will get to that later on in the slides. Okay, we've talked about the marginal tax rate examples, the personal ones, it's here. And this is the dividend rates example. So I included this here to show you that, let's go back to the personal one. So if you do not have a PREC, you pay 20% on the first $42,000 of your income. If you have a PREC first pays 11%, then when you take out the money as a dividend, on the first $42,000, you pay 10.43%. So in total, you're paying 21.43% if you have a PREC, and you're paying 20% if you are incorporated personally. So with a PREC, you always pay slightly more in almost every province in Canada, I think, except for 2, where you pay a little bit less with PREC. But with a PREC, you pay slightly more taxes if you're taking out 100% of the money out. But the point of a PREC is that you've gone to a point in your career where you have residual money that you do not need to take out. Therefore, you are deferring the taxes on those balances. Okay, I hope that I've explained this and you kind of understood the tax deferral aspect of this. I'm going to next talk about that million-dollar question, dividends versus salary. Okay, so we discussed that now that you've got a PREC, the PREC is going to pay corporate taxes. When you withdraw money, you can do it one of 2 ways. You can pay yourself salary. That means you put yourself on the payroll. You treat yourself like an employee. Your salaries become an expense to the PREC and will decrease the taxable income of PREC. But as you know from any employment experience, when you get salary, you pay personal taxes on that salary. Okay, so that's one way of getting the money out. The other way is for you to pay yourself little to no salary, and you end up taking out dividends and pay dividend tax rate, which is a smaller tax rate than a salary tax rate. Salary was the personal tax rate that I showed you in the first slide. Dividends is a smaller tax rate that I showed you in the second slide. So let me take you through some of the pros and cons. Under the dividend regime, one of the best reasons for doing that is you can split your income with your spouse or 70-plus-year-old children if they work in the business. For example, they work 20 hours per week of work on average. And I'm going to just delve into this for a moment. Keep in mind that if CRA audits you and says, show me the involvement of your spouse or children that you have paid dividends to, you should have some proof that they were involved in the business. For example, a typical document that would be useful is a chart that shows the hours they worked, the date they worked, and what they did. If they had an email address with the corporation, if they use the email address to do their work, those are all things that will help you prove that this person was involved with the business. So again, why would this make a difference? I will go to the marginal tax rate again. To the dividend tax rate. So here you're paying dividends. So let's just say that you have 50,000. Let's just say you have 100,000 worth of dividend that you want to pay out. If you pay all of that out to yourself, you will see that you end up getting over all the way up to the marginal tax rate of 31.40%. Okay, if you pay all of it to yourself, you pay 10.43 on the first 42,000, then 13.40 $47,000, on the 42,000 to 49,000, so on and so forth, and you eventually get to 31.40%. But let's just say that you have a qualifying spouse that you can pay dividends to, and each one of you gets about $50,000. You see that up to $49,000, you're staying at 13.47% tax bracket as opposed to the 31% tax bracket. So that can be a huge tax savings if you have a spouse that qualifies to split income with. Having a PREC and paying yourself as dividends allows you to do that. So the third bullet point says, now the balance is left in the PREC to be invested and to grow inside of the PREC. And this is what's called a passive income. So let's just say that you pay dividends to yourself and to a spouse, and there's a bunch of money left. You can take this money, you can move it up to your holdco, and then you can go out and buy an asset with it, or you can go and lend it and earn interest rates. And those monies would grow as passive income. So now you have to watch that. There was a caveat here that you have to be really careful about. Remember how I told you that the 11% smaller tax rate only applied to the first $500,000 that you made. Now, that $500,000 is what I call in this presentation a PREC limit. Obviously, if you go above the limit, you have to pay the full tax, about 27%, as opposed to 11. So that PREC limit is really important to you. But the way that our tax laws changed a few years ago, now start chipping away at the limit if you earn too much passive income. The first $50,000 of your passive income doesn't affect the PREC limit. But as you start earning more than $50,000, your PREC limit starts decreasing. By the time you get to $150,000 of passive income, your PREC limit becomes a zero. That means that you pay a gigantic 27% corporate tax rate on every penny of taxable income that you earn, okay? And if you are earning a lot of passive income, then we need to sit down and do some serious type of tax planning to make sure that you know what your options are. The other caveat you have to keep in mind is that if the total amount of taxable capital that your PREC has exceeds $10 million, let's just say you own a bunch of property with your PREC, which I told you you shouldn't, but let's just say if you did, that would also chip away at your $500,000 limit. And if you have 15 million or more worth of capital assets, then you get absolutely no tax breaks. So you have to watch out for those, and that's why it's important to not take this to walk away from this presentation and start your own planning. Just like you would never do your own root canal, you should never do your own tax planning either. You should definitely talk to somebody, because there's always an exemption to an exemption, and a caveat here and there, and things will change depending on your own personal circumstances. One of the things that we haven't discussed, for example, at all, is the concept of residency and non-residency. It's outside of the scope of this. Typically, all of you who are operating a PREC are residents of Canada, but under certain circumstances, you may have tax obligations to other jurisdictions like the US. And sitting down with a planner, a tax accountant or a tax lawyer will allow you to disclose some of the facts that are material to your particular case and get advice that makes sense to you. Okay, I told you I was going to repeat this point a few times, and I'm just doing that to make sure that you understand it. Let's go to the salary and bonus structure. So we covered what happens with dividend. Now let's see what would be the structure if you put yourself on payroll. If you put yourself on payroll, that means that you withdraw money before the corporation pays taxes. That means that the corporation ends up paying less taxes because your salary is an expense. You pay taxes personally from the marginal tax rate, which is this tax rate, because you're earning salary. Now, what does this do for you? You may have heard of registered retirement saving plans, or there are other registered plans out there. You must have heard about tax-free savings account. When you earn money as salary, it builds up for something called RRSP contribution room. Dividends do not do that for you. So if you do not want to invest yourself and you want to invest things into RRSPs, then you need to pay yourself salary in order to make room for RRSP contribution. And the way RRSP contribution works is that you can contribute to an RRSP account up to 18% of the salary that you earned the previous year, up to a certain maximum. So you've got, a certain amount of money, let's just say 20 grand of your income as salary that you can put into the RRSP account. You don't pay taxes on those, and you're basically deferring taxes, just like you did with the corporation. But this time, the growth of that money is going to be dependent on how the financial institution that has the RRSP is running their investment. It's basically somebody else investing for you, as opposed to you doing it yourself. The complication, like I said, is that you have to build the room first, which means in 1 year you have to have salary so that in the following year you can make the contribution. And there's a limit on how much of the salary you can put into an RRSP account. With tax-free savings account, you can put dividends into those as well. They do not have to be what's called an earned income. Salary is an earned income. You can put that into RRSP. Dividends are not an earned income. And so those are two different tax strategies. And if you sit down with someone, they may tell you that, okay, if you want to just not put all of your eggs in one basket and you want to pool your risks, and you could take this much as salary, contribute this much to RRSP, take out this much as dividend, and leave the balance in the corporation and invest yourself. And those become all the tools that you will use in your retirement planning. There's one last tool that I haven't put on this slide because it can get people into hot waters if it's exercised too excessively, but I'll tell you verbally what it is. You can also take money out of a corporation as a loan, but you have to pay that loan back within a prescribed period. Otherwise, CRA will assume that you have earned that money and you have to pay taxes on it. And so if there is 1 year where you've withdrawn a lot of funds from the corporation, you do not have enough money, enough cash to pay taxes, you could potentially put some of that money as a loan to yourself and then defer the taxes on that for another year. But you have to make sure you'll have the cash to do that in another year, or you can pay it back to the company within a year and then deal with it that way. If you've got a cash crunch and can't afford the taxes in one particular year, there are some playroom that you have when you have a PREC. So overall, PREC gives you way more playroom. There's a lot of things you can do. And even if you're taking the entire amount of the income as personally, the amount of extra tax that you will pay with a PREC is small. That it's worth having a PREC, so that if you do earn a lot more, you have all these tax planning tools in order to potentially pay less taxes or defer some of your taxes. When you defer taxes, you keep more of the money in your pocket for a longer period. That allows you to go out, invest that money, make it grow, and only pay taxes on it when you withdraw it later on. Okay, well, that's the slide that I was talking about. I basically mentioned that it depends on your personal circumstances. Make sure you speak to a planning professional and do not plan yourself. I have said enough about that. Let's talk about wills and family trusts. So I want to tell you what a lot of people ask me, what happens if I die without a will? If you die without a will, your property doesn't go to government, that's as opposed to the misunderstanding that a lot of people have. BC laws have a default will for you, and it depends on a number of factors. And that is if you have spouses surviving you, and yes, under our laws, you can have more than one spouse surviving you at the same time. And number of spouses that survive you. If you have children in common with any of those spouses that survive you, if any children survive you at all, and if you have no spouses and if you have no children, whether you have any relatives like parents, grandparents, nieces, and nephews. And if you have none of those, then yes, the property will go to the government and will be treated under something called the Escheat Act, which is outside of the scope of this presentation to cover. So what a will do is will give you control. Particularly if you have younger children, it's highly recommended that you write a will, because if you and your spouse unfortunately pass as a result of an accident, without a will, it's not going to be clear who's going to be the guardian of that child. And that child may have to go through a lot of hoops until somebody comes and accepts the role of becoming their guardian. We have seen this unfortunate situations, especially with couples that do not have any family members here, and they've immigrated to Canada. It's just them and their children. And if they both pass, their children will spend a lot of time in courts and foster homes potentially before someone from overseas can come and accept their guardianship. But if you had written a will that made it clear that, say, the grandfather from Moscow would come and become their guardian, that would make the job of the grandfather a lot easier. Now, when you die, the first bullet says, the death tax deems that you have sold all of your capital property before death at fair market value. And CRA assumes that you got money, even though you didn't, equivalent to this imaginary sale price. And therefore, you may end up paying capital gain on taxes. What is particularly important to realtors is that the shares of your PREC and your holdco would be an example of such a capital property. Before I go to the next bullet, let me just go back to the structure and show you here. Remember the structure? At the top, you see the realtor, realtor's spouse, and the realtor's children. Main holdco. Let's just say the main holdco has a bank account with a couple $100,000 there and no other liabilities. These shares would be worth a couple $100,000, and if these shareholders die, there would be a couple $100,000 worth of capital gain that the state has to pay taxes on first. So nobody went to the market and sold those shares. It's palatable for people when that rule applies to real estate properties, because you can go out and sell the real estate property, pay the capital gain taxes on it. But shares of holdco, there's no market for them. Nobody will buy them. So you could leave your survivors with a gigantic tax bill unintentionally if you've got shares of holdco having any value, which they would if they have cash in the bank or if they own assets. So what can you do to prevent this from happening? Now keep in mind that the last bullet says that you also have to pay probate fees of about 1.4% in BC of all assets. It should say approximately 1.4%. So if you die and you have $1 million worth of assets after the liabilities and mortgages on those assets have been deducted, then $14,000 of fees have to be paid. And this is not something that can be exempted on a rollover basis because it's a fee as opposed to a tax. So what I'll do is the next slides is I will show you ways to try to avoid your shares of PREC being subject to this death tax, and ways to avoid the 1% probate fees. Family trust. So the difference between this slide and the other one is, as you see, the shares of the main holdco are held by a family trust. You may remember from the first slide, I told you that the regulations allow the shares of PREC to be held by a family trust as long as the beneficiaries of the family trust are those three individuals. What is a trust? A trust has to be properly established, and once it's properly established, the players are a trustee, which in this case would most likely be the realtor, and a number of beneficiaries. These are the people that will receive benefits of the trust's income. So you can potentially pay that dividend that you are paying to the spouse through a family trust as a benefit. Now, the reason why this is better than the previous structure is that if any of these folks die, the realtor's spouse, or the realtor's children, there is no deemed dispositions of their shares, because family trust still holds the shares. It's just the beneficiary or a trustee that died. That person can be replaced. You don't have to worry about deemed disposition. In addition, you don't have to worry about the 1.4% taxes, because you don't have to probate anything. Family trusts are very complicated. They have to be built the proper way. They have to be settled the proper way in order for them to be valid. And on an annual basis, you have to make certain filings. So you make sure that you consult a professional on this. Here are some of the considerations. I've said that asset protection against liability is a bit better because you may have some protection on their family law. So let's just say that you build a lot of wealth, you have children, your children are the beneficiary of this family trust. If you make this trust what we call a discretionary trust, that means that your children will never have a say on how much income they're getting, then potentially you can protect the asset within a family trust from any division of assets that happens as a result of one of your children getting a divorce. That's something that sometimes is really important to folks. They want to make sure that their children enjoy their family wealth, but if they go out and marry and get a divorce, that spouse doesn't get any part of the family's wealth. There are limitations to that, and you should get all the proper advice with respect to it, but there is that additional asset protection with family trust that you can get. I mentioned that you avoid the death tax because there's no deemed disposition of shares. And this is particularly good for management of wealth for a minor or a disabled person's benefit. So let's just say that you have a child who's disabled or who might become disabled. If the wealth is sitting within a family trust, then you can appoint a trustee, which could be somebody you trust, or there are companies that do this for you for a fee. And that trustee manages the family trust assets and ensures that the disabled person is looked after. Okay, avoiding probate fees I mentioned, but like I said, it's complex. And the most important thing you should think about and remember is that a family trust is considered to dispose of all of its assets every 21 years. So the same consequence of death that I talked about happens every 21 years with the family trust. But obviously the difference is with the family trust, you know the exact date, month, and year that that's going to happen, and there's lots of planning that people will tell you can do to plan for that eventuality. Whereas with respect to your death, you don't know when it's going to happen, and you don't have the ability to make sure that the shares will have no value. Okay, so family trust will have complexity, but will provide a bunch of flexibilities. Here are a few other succession tools. Another way to avoid the 1.4% tax is that you take a property as joint tenancy. So let's just say you know that after you die, you want the property to go to your spouse and your children. and you can put everybody on title as joint tenants, and then you avoid the 1.4% probate fees. But keep in mind that if you're transferring the title, you may have to pay the property transfer taxes to do that. And so that's why you should get advice to see which one is better, the 1.4% or the property transfer tax. However, you do not pay property transfer taxes if that property has been a principal residence for the parent or for the child that's receiving the title for the past 6 months before the title gets transferred. So that's another kind of planning you can do. If you want to transfer it to a child, let's just say a rental property, you can tell the child to go move into the property, make it their principal residence, live there for a year, and then transfer it as joint tenancy to their name without incurring any property transfer taxes. There may be capital gain taxes as well, so that also needs to be looked into before any transfer of assets. You can also transfer your asset to a company or a trust on a rollover basis. What rollover means is that when you transfer the assets, you do not pay any taxes on this transfer. The taxes are deferred until the property is sold. Certain elections have to be filed with CRA, certain plannings have to be done, and a tax accountant can help you how to do that. Another tool that's very helpful, a lot of people don't know about this, is that you can have 2 wills. You can have one will that deals with shares of your PREC and another will that deals with everything else. And the benefit of that is that then you can have one will that transfers the shares of your PREC without having it go through a 1.4% probate fees. And another will that deals with every part of your assets. The way that our wills laws work allows you to have 2 wills, one that deals with shares of corporations only. But then you have to make sure that the directors of that corporations cooperate and that you have separate executors. Again, getting proper advice on this to structure it properly makes all the difference. But keep in mind that you still have the deemed disposition of shares in these cases anyway. The only way to avoid that would be a family trust. And finally, you can gift something to somebody before you die, but be mindful of capital gain taxes and property transfer taxes. So all of these succession tools, all of them have caveats and exceptions to them, and you have to make sure that you're seeking advice properly so that you don't end up incurring taxes that was not intended. Okay, last slide is I want to give you this checklist, and I'll end it with this and see if you have time for questions. First of all, seek advice from a qualified wills and succession planning advisor to build a personal structure catered to you. And that means a tax accountant or a tax lawyer. The difference between an accountant and a lawyer, the major difference is that what you talk to a lawyer about is protected by privilege. What you talk to an accountant about is not protected by privilege. So it's easier for the CRA to bring your accountant as a witness and ask them questions. It's much harder for the CRA to have any access to our records or ask us as lawyers to be a witness. Draft a will with a lawyer. I know notaries can also draft a will for you, but our laws do not permit notaries to draft a will that includes a trust within a will. So for example, if you want to write a will that says, when I die, my property will go to my spouse, a notary can write that for you, cheaper than a lawyer. But if you want to say that when I die, my property will go to my spouse for the life of my spouse, but after her death, will go to my children, you're building a trust within a will, and a notary is not allowed to write that for you. And why would you do that? You would do that because if your spouse goes and has other children and from another marriage, you do not want the wealth that you originally acquired to go to anyone but your own children. So that's why it's important to make sure that you plan for those eventualities that a notary cannot plan for when you go to them. If you write a will, which you should definitely file a will's notice with BC Vital Statistics. And what that does is it tells the entire world that you have a will and the location of your will. With respect to realtors, the thing that I've seen come up is a lot of verbal agreements around commission arrangements. You tell someone, okay, you've helped me with this pre-sale, I will give you half of the commissions when I get my share of it. And this may not be in writing. Therefore, if something happens to you, then your executor wouldn't know what are some of the contractual obligations you have made. Putting these in writing is important. And the last thing says that if you have these future commissions and liabilities that are coming up, it's best to put them in an Excel sheet, tabulate them, make sure your executor or somebody else knows where they are, so that down the road, there isn't a conflict about how much you were supposed to get from somebody or how much you were supposed to pay somebody. This especially comes up with realtors that are working in pre-sale market where the commission may not come to fruition, at least part of it, for years later, and life happens in those years. Okay, so I have talked a lot. I think I went a bit over my time, and I think I hope you have found this useful. My email address is on the very first slide, and I believe this presentation is going to be emailed to you. And if I can be of any help, you're welcome to email me. I know last time I got a ton of emails, and I tried to respond to as many of them as I could. If I don't respond to your email, send it to me again, and I'll make sure that I'll eventually get to it. So there you go.
Great. Thank you so much, Bijan. That was wonderful. So informative.
You're welcome.
Yeah, thank you. So we're going to do questions. So just a reminder, when submitting your questions, to read it before you submit it to make sure it's clear and makes sense. And that just as Bijan had said, that none of this is actual legal advice. Please consult a tax consultant or financial planner, etc., for any details that you need. Now we're going to start off with some easy ones, Bijan. What are your thoughts regarding realtors waiting to create a PREC until they're making more money?
I think that makes sense because when you're incorporating, you are incurring some costs. First, you should be incorporating at least 2 companies when you're incorporating, and so you have an upfront cost, and then you have an annual cost of accounting and maintenance costs of annual filings. And it makes sense to have those costs when you have enough income that you're leaving some residues in your corporation. But you may not know if you're going to get a big deal and you're going to make a big commission. And so if you're getting to a point where in your career where something can happen, then you better incorporate as soon as possible.
Okay. So I have another question that might not be for you, but you probably can answer it. Are we able to use our PREC or holdco to buy stocks?
Yes, you can do that. Now, the rules say that your PREC can only be used to deliver real estate services. So you can't use your PREC to do any other business. The law says only real estate services and things that are ancillary to it. But you can hold assets, and stocks would be assets. It would be not advisable to do that, because then if somebody comes and sues your PREC, then all of those stocks would be available for them to recover damages through. So you should never do that. You should have another holdco where you buy assets through, but there's nothing prohibiting you from buying stocks through your PREC. Okay,
wonderful. And do you think it's advisable to set up a PREC in November or now to claim for this past 2021 year?
Okay, so if the PREC didn't exist this year, the commissions that you have earned were earned personally and not by the PREC. And so, you've already lost this year. You should be incorporating, and you can use the remainder of the year or start January 1st.
Okay, that makes sense. Is it possible to donate some shares of a PREC or holdco to a charity to lower taxes upon death?
So from the first couple of slides, I mentioned to you that there's a limit on who can own shares of your PREC. You, your spouse, and your children, or holdco. So you cannot give shares of your PREC to a charity at all. It's just not allowed.
Okay. Let's see here. If you own properties overseas, are those properties subject to CRA regulations and taxes when the owner dies?
If you are a resident of Canada, which in your case, if you're a realtor here, you're most likely a resident of Canada. When you die, your entire wealth around the world is subject to taxes in Canada. So if you've got $10 million worth of property in another country, let's just say in England, you die in Canada as a resident of Canada, then CRA assumes that you sold all of that 10 million in England at fair market value, and you have to make, and then your estate has to pay capital gain taxes on all of those overseas property. It's a complex issue, and you should definitely seek some advice. When you fill out your taxes, you file a schedule called 1135 to disclose to CRA any property you have. The cost of acquisition is more than 100 grand. I'm going to stop there and tell you, make sure you seek advice, because if you end up dying without accounting for those pieces of property, you could leave your executor with a huge mess to deal with.
Right, that does make sense. And so another question is, what if you already have a PREC and a holdco? Can you restructure, add shareholders as life changes? So if you're single in the beginning and then later you get married, then you have children.
Absolutely, yes, yes. And we do that all the time here. We do lots of reorganization. We do lots of planning. We work with your accountant to do that. Absolutely, you can do that restructure.
Wonderful. And then we do have a question. Oh, where did it go? Oh, do I have to register each amendment to my will at the wills office?
So when you write a will, you register the will. If you amend your will, we call them codicils, and you can register the codicils as well, so that then when you die and somebody goes and searches, they see that there's a will and there are a bunch of amendments. But what we typically like to do, instead of doing an amendment, which can then cause interpretation issues, is that we just revoke the past will and then just write you a new will. Remember, the thing about interpreting a will is that it happens after you die. You're no longer there to be a witness to say what you meant. That's why it's really important to have it done by somebody who really knows how to write well for you. And if you've got too many versions of an amendment, it could potentially cause a conflict about interpretation. So we usually don't recommend it, but in theory, the law does allow you to do that. And yes, you would register each amendment separately so that somebody has the full picture when they do a search.
Okay, perfect. Another question, we're gonna be jumping around between wills and precs because it's all over the place, but when transferring money from the prec to the holdco, is there any tax implication? And is there a reason you would want to hold more funds in your prec versus your holdco?
So when you transfer money from your prec to holdco, no tax consequences. And when you take money out of your holdco, you pay taxes on it. And the reason why you want to take the money from your prec and put it into holdco is for asset protection. If it remains in your prec and somebody sues your prec, wins in court, then every asset in your prec is exposed. But if it's in your holdco, it's not exposed anymore. However, keep in mind what I told you about the Fraudulent Conveyance Act. If you do this transfer after you know that somebody's after your assets, then that transfer is void. So you have to do it at a time where it's for other reasons.
Okay. What should we do if we want to use a personal name instead of prec after a couple of years? What happens to the prec?
So the rules, the regulations require you to name the prec your own name or a name that you're known as, plus the word personal real estate corporation. As long as it's delivering real estate services, you don't have a choice as far as the name is concerned. But if you stop being a realtor and you just want to continue using that company, you have to change its name because it's no longer a PREC, and you can turn it into a number company, you can turn it into a new company. It's a legal entity that could now continue as a completely different operating company.
Okay. So there's a question I don't really understand, but you might. What is the difference between family trust and alter ego trust? Which one is better?
Okay. So an alter ego trust, you have to be over 65 in order to do an alter ego trust. It's a completely different animal than a family trust. Besides alter ego, we also have spousal trust. And these are also certain planning tools that you can take advantage of. The difference between that and a family trust is realistically outside of the scope of this. And I'd have to spend about an hour, depending on your circumstance, and telling you what differences it would make for you.
Okay. No, I'm going to make sense of this question. When a realtor made a PREC previously and didn't make a holding co above the PREC, can they make a holding co now? And is there any considerations about remaining current balances?
Yes, you can definitely make a holdco now. You can transfer shares from yourself to the holdco, and an accountant should help you along with a lawyer to do that, to make sure that you don't end up being assessed taxes, because you're essentially transferring an asset from your name to another entity. That's a taxable transaction, but an election can be made. We also do estate freezes in order to make that transaction tax-free. So yes, it is possible. It just has to be done the correct way.
Okay, perfect. And does PREC help with declaring income in the US?
I don't know about that. You would have to ask a US tax person. I only know BC laws, Canada laws, that's it.
Okay. How much income is good to start with a PREC? Just roundabout.
Okay, well, it depends on how much income you take out for your, depends on your lifestyle. If you make 100 grand in the PREC and you need the entire 100 grand to live in the Lower Mainland, which I wouldn't be surprised if you did, then that's it. But if you are happy with taking out 80 grand and 20 grand of it you don't need, then you should definitely have a PREC in order to defer the taxes on those 20 grand that you don't need.
Okay. And then for this one, is it possible, or do you pay dividends from your PREC holdco or the PREC to yourself and the spouse?
So you would be, okay, so in the holdco structure, you would be paying dividends out of holdco to the realtor and to the spouse.
Okay. Let's see here. If I retire and change my PREC name, will there be capital gains or a tax implication?
If you retire and you stop basically practicing being a realtor, you haven't disposed of any of the shares of your PREC, and there are no tax consequences. No, you just stop making money, and the value of those shares start dropping because you're no longer earning any income inside that PREC.
Okay. And then there's one, you mentioned the holdco does not have GST numbers. Can a holding corporation ask for GST rebate when purchasing a new construction property?
Okay, so if the holdco is going to acquire a new property and is doing it in the course of doing business, that's the other condition, they can have a GST number and they can be exempt from GST. But you have to be careful that the holdco is doing it in the course of doing business. That's the other requirement, and what it means is something that you should seek advice on to make sure that the exemption you're seeking, you're actually getting. It's not enough to just have a GST number. There are additional conditions.
Right, okay. And then can we withdraw a dividend and salary in the same year?
Yes, you absolutely can. And that's why you go see a planner to tell you what the best combination might be.
Okay, perfect. Let's see. Dividend shares will be taxable. Can we out that question? I feel like you've already answered. Let's see. When taking a dividend, is it necessary for both the realtor and spouse to take the dividend together?
No, absolutely not. And that's why originally I went through Class A, Class B, Class C structures so that you can pay your spouse a different amount of dividend at a different time than yourself.
Okay. And can your divorced spouse make a claim on any of your holdco, your prep, or anything after you die?
Depending on the date of the separation and what the relationship was, they could still be considered a spouse. That's why in my slide with respect to wills, I mentioned that you could technically have more than one spouse. And so, and that really depends on what the history is and whether they fall within a definition of a spouse. But theoretically, it is possible.
Okay. If I decided to stop my prep, what would happen?
Okay, stop, depending on how you stop it. If you just, the easiest way to stop and exit a prep would be to finish your year end, finish all your accounting, pay all your taxes, withdraw all the money, pay all the taxes on that, and then you dissolve the prep. You can go back to being a realtor and earn income personally, or just go and do something else other than being a realtor in your life.
Okay. It's a lot of repetitive questions, so I'm just trying to work through it. Says based on your info, if I make 120K, how much generally will my tax be? Is it time for me to open up a corporation?
Okay, I don't have a tax calculator inside my head, unfortunately, but you can Google search a tax calculator BC, and you can get that number. I think 120 grand, if you're in Lower Mainland, I think that's a pretty good number to start doing a prac, because presumably you're going to start having some excess income that you don't need to use. So I think at 120, that's a good number, yeah.
Okay, perfect. And can we purchase investment properties under our holding companies?
Yes, yes. Like I said, though, properties, plural, you should buy each property under a different title code. And all of those title codes then should be under the holdco. In order to make sure that if an accident happens on one property, then the persons that are claiming damages with respect to that accident only have access to that one property. If you have one holdco that has a number of properties, like 4 properties, then one accident happens in one property and somebody sues you, they're suing the holdco, and holdco potentially has all of these other assets that they can have access to. So better planning is to make sure each asset is a separate holdco, and then all of those holdcos are owned by a main holdco.
Okay. And can you blend a prep and a non-prep corporation, or do you have to keep them separate?
Sorry, can you repeat that? Can
you blend a prep and a non-prep corporation, or do you have to keep them separate?
Okay, so a prep can only do business in the real estate services. So if you are going to amalgamate them, there are tax reasons sometimes to amalgamate a company, but the resulting company, you have to decide if it's going to be a prep or not a prep. And if it's going to be a prep, continue as a prep. It has to meet all of the requirements. And if it's not going to be a prep, then there are no issues. But yes, you can amalgamate something with a prep. You just have to decide what the newborn is going to be.
Okay, let's see. Let's find one last one. Let's go for like a popular, relevant one. Is it better financially to invest with your holdco, invest in crypto versus investing personally?
Was the other option crypto?
Yeah, investing in crypto, but yeah.
Okay, right. Well, so that's outside of my scope of work. Unfortunately, I'm a lawyer, not an investment advisor. So I can't tell you which one is better. You got to talk to an investment advisor and I know that I have family members who've made money in crypto. I have family members who've lost money in crypto. So I don't know.
Yeah, I'm the same. Okay, so we're gonna wrap it up. So thank you, Bijan, and thank you to all the attendees for joining today. Please remember to fill out the survey that will pop up after this session. We're getting a lot of thanks and happy to have you back, Bijan, from our members. So thank you again, and I hope you guys all enjoy the rest of your day.
My pleasure. Thanks for inviting me.
Okay. Bye-bye.
Bye-bye.